8 assignments, I think average 70, I would say. Group assignment, average. I think the lowest I have given also 60 something, lowest. Highest one near 80, so average like 70. But it's just come to individual assignments, I cannot help. It's like individual, they are losing a lot of marks. Hey, 2 pages only. Some of them give me only not 1 page, How do I give mark? You need to think about that. I mean, in the future, when you come to assignments, look at the marking rubrics, very important one, because as a marker, when we mark, we base on the marking rubrics, the marking allocations. So if you see something is there, must be included in your assignment. Just like what I said, few students really, the other conclusion, 40 marks allocated for conclusion. The other conclusion, supposedly is 0, but I still give some pity mark, 5-10 marks out of 40. So I read carefully for the, what you call that, the question. All right, you don't need to think about that because already passed. You have already submitted, so you just wait for the comments Don't get too worried on that even though I'm saying that it's strict but it's not really strict also I think average Like what I said, average, I'm giving like 70 marks one. Okay. All right. Okay. The first thing I think I want to, like usual, a very short revision will be given to all of you. Okay, so today, actually today will be the working capital policy, but we have the first question is like from last tutorial, and that one is the specific discount rate. Okay, we talk about that one first. Using this one. Okay, if you remember what we have learned last week, what we have learned is the WACC, and just now from the lecturer class, I have just given one guideline for your midterm next 2 weeks. One of the questions will be WACC, will be this one. Definitely related to this one. So make sure you practice. There are 2 questions in your midterm. One of them will be something like this, related to this one. Okay, WACC. And this one also under WACC. So make sure you know how to calculate. Okay, if you remember, we have discussed some things like how to calculate the WACC, weighted average cost of capital, is actually the cost from all your sources of finance. And we need to use it as a discount rate for the new project, because this one is the cost of your capital. And how to calculate that, if you remember, we will be calculating the cost of each source of finance, and then the market value for each of them. Then at the end of the day, WACC. All right, we combine them. Why do I need to share this one again? Because the coming later on, the revision will be related to this for question 1. All right, so this one is what we call current WACC, the current cost of capital of your company based on the existing capital structure. This one is the existing capital structure, 1M, and the existing cost of each source of finance. All right. And if let's say this one, I think from last class one. So if you want to use back this 7.33%, let's say this is the weighted average cost of capital of our company. If you want to use back this one, all right, for calculation of NPV as the discount rate for a new project. If you remember last time when we calculate NPV for new project, the discount rate is cost of capital. So if you want to use back the current WACC as the discount rate for new project, all right, we must make sure we meet certain conditions. Actually, we have already discussed that last week, including first, the new project must have the same business risk. Like what I told you all, if I'm selling fruits one, make sure the new project also selling fruits. Same business risk. Then we can use back this 7.33%. Why must be the same? Because you must understand, your 7.33 is calculated based on your current situation, the current business that you are doing, selling fruits, all these things. If let's say now you are going to do something totally new, like healthcare business, then I can tell you, KE definitely change one. Because you imagine if you are the shareholder of this company, you invest because you have confidence on this company in selling fruits, very experienced in selling fruits, let's say. But now this company suddenly changed to doing something totally new, no experience one, a new business. So what do you think? Your risk perceptions will change. And when your risk perception change, KE will change one. And when this change, do you think that your WACC will be still 7.33? No, because as you can see, when this 10% change, this one will change also one. So that's why if you want to use back this, the same one, 7.33, make sure the new project is having the same business risk. All right. The second will be the same financial risk. Financial risk, it means that this is your existing capital structure. Your financial risk is like equally 1/3 common share, 1/3 preference share, 1/3 from borrowings. If you were to raise new fund for new project, you want to raise new funds for new project, and you want to use back this 7.33, you must make sure the new funds being raised follow this proportion. So like the new fund must be also 1/3 you get from share, 1/3 you issue preference share, 1/3 from borrowings, in order to use back this one. Because again, the same thing, if you invest in a new project, but you only use common share, issue common share, raise fund for the new project, can you still use back this one? You can't, because this one is based on a combination of 3 sources of finance. You cannot use back your current WACC. All right. And then the third one must be small size project only. So the new investment must be a small project, because again, the same thing. If big project, I can tell you KE definitely changed. And when KE changed, this one changed. You cannot use back 7.33, your current WACC. Okay, that's the conditions. If you want to use back your current WACC for the new project. But definitely, okay, like what I told you all, how about if really we want to invest into something new? This one I use for, okay, let's say, look at this one. Just now our WACC, current WACC is 7.33%. And remember, if you want to use back this current WACC as a discount rate for new project, you must be able to meet all these conditions to use back this 7.33. But now our case, let's say, CK Berhad selling fruits one. Now our company wants to invest into healthcare business. So I ask you, if we were to invest into this healthcare business, can we use back this 7.33% based on our current WACC? The answer is cannot. Why? Because like what I said, is not the same business risk. We cannot use back this one. This one is based on the existing cost of equity. If you invest into something new, the KE definitely change one. So that's why in here, we need to use project-specific WACC. We need to use this one. Project-specific WACC, from the names, it literally is telling you that this WACC is only for this new project. So we use this one as a discount rate. So how to calculate that? Okay. So this one, I think all of you know the CAPM model, KE CAPM model. So since we are looking on the another company, okay, it's not another company, we are doing a new business, healthcare business. So actually we can use a healthcare company as a proxy, and then we use their information to calculate our own KE. Let's say IHH is a healthcare public listed company, this one. Okay, so let's say if we know that the beta of equity of this IHH is 1.5, so can we just use this one as a proxy, apply to here? Then we will get the new KE already for doing that kind of business. The idea is like that, but still have one more step we need to do. Because all of us, we need to understand that we cannot take that directly. The reason is because like this beta of equity of this IHH, this company doing healthcare one, we want to use this one as an example. But the BE of this company includes two risks. BE includes BA, business risk, beta of the asset, and the beta of debt and the financial risk of this company. That's the reason why we cannot use this one directly apply to here. We cannot just 1.5 very simple. I take this one, apply here, then I calculate one new KE, then I can calculate the WACC. We can't do that because this one includes their financial risk. All right. So the first step we do, we need to exclude this financial risk. And it's also what we call ungearing, this formula. Ungearing. So the first step, later on the question one, you will see we will be doing this one, ungearing. So what is ungearing? Ungearing is same thing, we were to invest into a new business. We cannot base on our current WACC, we need to follow their PE. But the problem is their PE including the financial risk. We don't want this one. So we ungear the financial risk, we take only the business risk. All right, so once we have the business risk, we will do regearing here. Regearing. So what is regearing? Regearing will be, we are taking this business risk, healthcare business, plug in, gear up with our own financial risk. So this BA plus BD, we will have a new BE. And this new BE is the appropriate BE for this project specific WACC. Reason because if we are doing that, it means that now this PE is a BE of a company doing healthcare business. So it matches our objective because we were to invest in healthcare business. So we are following their business risk is correct. Okay. And we gear up with our own financial risk. So this financial risk is also the financial risk of our company. So by doing that, we will have the project specific beta of equity. Then we apply here to get the KE, and later we can calculate the project specific WACC. That's the whole idea, very complicated. Understand, good for you. If you don't understand, you memorize this formula. Okay, this will be the steps to get the answer. Now what I said, so even though you don't understand what I explained just now, let's say if you understand, good for you. If you don't understand, also doesn't matter, but at least you need to understand. When we come to project specific discount rate, what does that mean? Why do we need to calculate a project specific discount rate? It is because usually when you use this one, it's for a new business, totally new business. For a new business, we cannot use back our current WACC because it's no longer accurate. Because our current one is reflecting our current business, what we are doing. For a new business we were to invest, we need to calculate a project-specific discount rate for the new business. And here will be the stats. First of all, we find the beta of equity of a proxy company, the company that is doing that kind of new business one. We follow their BE, but we need to do ungearing and regearing. Why we have all these formulas? It's because like just now, what I said, we cannot just take this BE because the BE also includes the proxy company's financial risk. Like maybe their borrowings 90%, your borrowings 10%. Can you just assume it's the same? Not the same. So what we do, second step is we take out their financial risk first. We don't talk about the debt first, exclude all the debts to make it fair, only business risk. So we do this. And later on, we take the business risk back to our company. We regear with our own debt, regearing. Then we will have the appropriate BE, or we call that project specific BE. Then we apply the CAPM, we will have a new KE. And with the new KE, it's like usual, like this one, just that now our KE changed, and then we apply the new KE, then we will get the new WACC. And the WACC is for the new project one, will be the accurate discount rate. Okay? Even if you don't understand, remember, when you look at this one, you look at this one and this one, it seems like the same. This one is the value of the equity, okay? But they are different. when you are doing ungearing, remember everything here, everything in this part, you are using the proxies figures. Because if you understand here, the first step, we are trying to exclude the proxies company's financial risk. So which means that here, they are all proxies figures, not your company figures. Until we are doing regearing, even though we are also using VE, but this VE is for your own company figures. All of this will be your own company figures. So as you can see, because common mistake from students will be that think that these two will be exactly the same one. I have seen your seniors, this VE using own company one, and when come to here also using own company, then wrong. Remember, when you're doing ungearing, the first formula, you are using proxies figures, not your own company. Only when it comes to regearing, you regear back your own financial risk, you are using your own company figures. All right, I think that's all for the revision. I think the group can present the answer right now. Yep.
Hello, sir. Can you hear me?
Yeah, I can hear you, Xiangyan.
So I will be presenting question 1. So the question 1 is to calculate the cost of equity of company using the dividend growth model. So by using the dividend growth model, firstly we need to calculate the growth rate of the company. So the formula of growth rate is n square root with the dividend in year x divided by dividend in year x minus n, then minus 1. So the n we can get from the above table is 3 because from 2018 to 2021 is 3 years. So the dividend in year x is the latest dividend, so it's 62. And the dividend in year x minus n is equal to the dividend in 2018, which is 55.1. So the cube root of the 62 divided by 55.1, then minus 1 equal to 0.0401 is also equal to 4.01%. So the growth rate of the company is 4.01%, and we bring this growth rate into the cost of equity formula. The formula of cost of equity is most recent dividend times 1 plus the growth rate, and then divide by the X dividend market price plus the growth rate. So the most recent dividend is 62 cent, then then multiply with 1 plus growth rate, which is 1.0401, and divide by the X dividend market price. So from the question is 7 ringgit and 60 cent, but in this equation the 62 we use cent, so the 7 ringgit 60 cent we need to times 100 so it's 716. And then plus the growth rate is 0.0401, and then we can get 14.02. So it is equal to 14%. Yeah, that's all. Any problem?
Okay, correct, but 13%, not 14%.
Sorry, 13%.
Very good. Okay, you are right. And you are lucky enough to do these questions, okay, as a revisions for your midterm. Like what I said, the midterm is not very hard, trust me. If you can do all the tutorial questions, then you should be able to do the midterm also. All right, you may continue. Thank you. This one is just some things like last week.
Okay, I will be presenting the part B. So the part B asking for calculate the weighted average after tax cost of capital of card company using a cost of equity of 12%. So the question given the cost of equity of 12%, the next thing we need to find is the cost of debt. In order to find cost of debt, we need to compute the MPV. So we use the try and error. We put 5% of discount rate, discount factor, and 15%. So based on the question, the market value given for the debt is the redeemable bond is 103 then and 42 cents. So we just plug in the figures, and the annual rate interest is based on the 8.5% multiplied with the 100 US dollar. Then you will get 8 ringgit 50 cent. Then you multiply by after tax rate. So you will get $5.95 for per annum. Then redeemable value, the question given is given that the market value of each bond is $100. So we just plug in the figures, then multiply with the discount factor of 5%, then you will get the PV of for each of them. Then for the total MPV of 5% discount factor, we will get 0.74 US dollars. So for the 15% discount factor, you get the total MPV is negative 33 US dollar 77.6 cents. So next we will proceed to calculate the IRR. So the IRR is taken by the one of the discount factor plus the 5% of MPV discount factor is $0.74, then divide by the 5% discount factor MPV, then minus by the MPV of discount factor 15%. Then after that, you need to multiply with the difference between the both discount factor, 15% minus 5%. So the final answer we will get for the cost of redeemable bonds is 5.2%. So the next, because the question is asking for calculating the weighted average after tax cost of capital, then we need to find out each of the type of finance market value. So for the equity part, we take the 8 million from the question, 8 million multiply with the X dividend market value of $7.16. So you get the market value of 57.28 millions US dollar. Then for the redeemable debts, you will taken the 5 millions. The 5 million is given in the nominal value, so we need to convert it to the market value. So we need to multiply with 103 US dollar 42 cents, then divide by $100. So the market value for the redeemable debt will be 5.171 million US dollar. So now we are going to calculate a weighted average cost of capital. So for each of them, in order to calculate the equity market value, need to multiply with the cost of equity, and for the redeemable debt also need to multiply with cost of the debt. So divided by the weightage is taken from this total 62.451 million US dollar. Then the final answer you will get is 11.4%.
Very good. Okay. I think I like you have explained that very well, Xiang Yuan and Junming also. Okay, I appreciate your explanations on that. So basically nothing much for me to add. Actually A and B, they're exactly the same with what we discussed last week. Okay, just additional revision. So the new thing actually is C. Okay, so you all may continue.
So for question C, calculate a project-specific cost of equity for company for joint venture. So the step one is calculate the ungearing. So the asset beta equals to the equity beta followed by the formula, and the figure is using the proxy figure provided in the questions. So the 1.038 is taken from the question of the equity beta, and times the 0.75 is taken from the question, also 75% by the equity. So we use the 0.75 divided by 0.75 plus the 0.25. The 0.25 is the 25% by the debt. Then we times the 1 minus 0.3, and the 0.3 is the tax rate, plus 0, the 0, because the question didn't provide the debt beta, so we no need to calculate this. And we calculate all the figure, we get the asset of beta is 0.84. So the step 2 is to calculate the regearing. For the regearing is using the company figure. So the equity beta equals to the asset beta times the market value of equity plus the market value of debt, then times 1 minus the tax rate divided by the market value of equity. So the asset of beta 0.84 is taken from the step 1, and we use the 8 million times the $0.16 to get the market value of equity, and plus the 5 million divided by 100, because of the 8.5% bond, the market value of each is $100 bonds. So we need to divide it by 100 and times the 103.42 and then times 1 minus 0.3, then divided by the market value of equity, then we get the total of 0.193. So after calculate the step 2 and step 3 as step 1, then we calculate the step 3 using the capital asset pricing model. So the KEG is the cost of equity in a beer company, so equals to the RF plus equity beta times the RM minus RF. So since the question provided the average equity risk premium, so the RM equals to the RM minus RF is directly taken from the questions 0.05. Then we calculate all the figure, we get the 8.5%. That's all.
Okay, also very good explanation from Ivy. So I don't think I need to go into details. Okay, for the other students, when you come to, because this one is one of the midterm test questions, like what I told you all. So I think if you have any questions that you are not sure, feel free to ask few of them. Okay, from their explanation, definitely they know what they are doing from the like how to pick the figures, all these things. You can ask them I think they definitely will be able to answer your question. But just long-winded a bit. Last thing, common mistake from this kind of project-specific discount rate. Can you show me the first step? Yep. For the first step, remember, Ivy just now has already explained that very well. This one based on proxies figures. Don't use your own company figure in here. All right. So if you read the questions, the question will be telling you, oh, this one will be 75% is I think 75% will be the equity and 25% will be the debt from here. Yeah, as you can see, the proxy company highlighted in yellow. So when it comes to first step, always based on proxies figures. Sometimes they will give you percentage. Sometimes they will give you like the market value. So actually the way is the same, just that you need to follow. Then when it comes to second step, that one will be based on your own company market value. Okay, so thank you for your presentation. Well done. Everything is correct there. Okay, so I will take over the screen. Thank you. All right, so that's all for the calculations of WACC. So if you ask me a WACC calculation, what do I need to know? Very simple. Okay, back to here. For your midterm, this one and this one, you must know. I can tell you right now, this one and this one, you must know how to calculate. I think calculation just like that for WACC Another calculation I won't tell you all it could be anything. You all makan sendiri that one. Okay, another calculation, it could also be this working capital management could be. So now let us talk about the maybe have a break first We have a 3 minutes break. Then we come back to the last two questions, question 2 and 3. That one will be for new topic, working capital policies. Wow, today 21,668, getting more and more. Oh my God. Kedah and Johor are catching up already. Wow, Kedah 2,000 something. Johor also 1,700. Oh my goodness. So many. But I can tell you it will be getting more and more with the, because later also it was like second phase one they are, I mean, already lifted for the, if you are taking the second dose one, then feel free to do whatever you want to do So this one, I think the cases will be keep on climbing up Penang also a lot Penang also 1,000 something I saw. Now Perlis is the safest, only 23. Penang phase 2, yeah. But it's no longer the number I can tell you based on what I read all the news. Actually now we are, we are following some things like US, US has already gone through whatever is happening here. US, when you look at their past few months, they also open up, they also don't care. Because it's actually no choice already. I know a lot of people will be saying that, wow, crazy government, you still, open for those like now 20,000, then like a lot of like states, they are lifted up already. But I can tell you, no choice already. No choice. You close, you continue your MCO, also useless one. At the end of the day will be the between vaccine and yeah, you are right. Now it's no longer Delta, it's Lambda. It's about the vaccine versus Lambda or the new variants. Hopefully, we do not have any other new variants that our vaccine unable to, overcome that one. Then now we look at US, I can tell you, look at US will do. Look at US will do. Seriously. You see US from 5,000, 10,000 cases and then they open up like no need to wear mask one, I mean in US there, because their vaccination rate, I think it's 70 something percent already. So open up, now increase back to 100,000 already their cases. But I can tell you unless the variant, there will be some new variant that is like too powerful. If not, I tell you, they won't close down, they won't lock down again. They will just open. Trust me lah. After second dose we also follow open one. So definitely someone will sacrifice one lor. You must be backing lor. You are not the 0 point something percent lah that actually bye due to this COVID-19 one, because we have no choice. We cannot continue like that also. I think I foresee a lot of us also will gonna, like you look at US, I can tell now a lot of US citizens, they will be tested positive already, just that they did not go for the testing, because after your second dose, we call it mild symptoms, some of them kena already, they also don't know one. I think next year, probably next year. Now the only risk I can tell you is the variant. Don't what lambda after that, don't know what super duper lambda, then if like there will be a more powerful one, the death rate is like too high one, then I can tell the whole world also GG. Whole world continue to close lor. If not, I can tell you is based on we count on the vaccine lor, and then your own immune system lor. Trust me, now is what they are doing, what the advanced countries they are doing, US, UK, they are doing that. So definitely all kena already one, but they don't care because you have already been vaccinated. So don't care, you kena already, the chances for you to die is very, very low actually, if you read. The chances for you to die is very, very low. Based on what I have read, the vaccine actually protect you from those like serious one. The serious one is very, very low to happen that, cause you to death. So maybe you have only mild symptom. So and based on experts, this COVID-19, after you recover, if let's say touch wood you kena after you recover from that, in short period of time, you won't kena second time. So which means now US and UK, what they are doing is they open law. For to die one, so sorry you are the not lucky one, then so sorry you die law. But very soon, if let's say we do not have the variants, new variants coming out, okay, and the vaccines able to, now we have a lot of new vaccines also coming out, okay, they are coming one, still have a lot, 20, 30 new vaccines coming out. If able to overcome that issue, then maybe we will see a hope there lor. But if let's say there will be a new variant saying that, now the existing vaccine all double pakai one, death rate very high one, then GG continue to lock down until you graduate, you also cannot come back high, you see, I think. Yeah, Wing Xiong, I think so lor. Now a lot of countries also, like advanced countries also waiting for you want to kena one, you kena lor, then after that herd immunity lor. So all immune already for that. They are doing that I think we are going to follow. You see our cases don't care already now, because you care also useless. You can close how many months? You close 3 more months then send things off. This one will be still there, the virus will be still there. Even though you are vaccinated, the virus still there one, you still kena one. It's just that if you are vaccinated, then the impact is no longer that serious. The effect mild symptoms they call that. Hopefully Cannot throw the hat okay. All my students just graduated one also very kasian, is it? Hopefully next year hopefully. Now I'm very concerned. I'm not looking on Malaysia already. I'm looking US one. So I want to see how that settle. Their cases also research, from 5,000 and then open up, not wearing masks. You see all they go to party, watch those NBA final, 60,000 people, outside the arena, 60,000 people you see outside. It's like this case no, but the COVID actually still there. It's just that the kernel also nothing already, because their vaccination rate reached certain level already. But now 100,000 already, you see. Very fast research. It's expected one, like Malaysia, I can tell you open also definitely research. But they don't care already one. So wait until the death rate is very, very low. It means that people die from this, it's like at the end maybe only few. Everyone also kena before already, then okay lor. Hopefully it's like that lor. But the worry will be the new variant lor. If like mutate again, then so sorry this one we also do not know Mutate again, now the vaccine double pakai, then really we cannot see the root already. Okay, I think we continue to the working capital. Again, a quick revision. This one is not about calculation, just a little bit on theory. So when we come to working capital management, I think all of you know working capital, there are the short-term assets needed by the company for daily operations. So in working capital policies, we can be separated into working capital financing policies and investing policies. All right. Both of them, they are also having moderate, aggressive, and conservative. It means that we have moderate working capital financing policy. We also have moderate working capital investing policy. But here, like what I told you all in the lecture class, they are totally different things. Why do I want to show you all this for your revision? Because this one is also a very popular question. Okay. I have set this question before in the final, and I'm asking, at that time I was asking investing policy, but a lot of your seniors don't know whatsoever reasons they expand financing policy. And I can tell you 9 marks for that. 3 policies, 9 marks. If I'm asking you investing, you expand something related to financing, you'll be awarded 0 mark. It's 0. It's totally different thing. So make yourself very clear on what the question is asking. Okay, we will look into that. Quick one. So pretty simple. The difference will be, if we are talking about working capital investing policy, is basically saying that how much money you have invested for working capital, like inventory, how much money you have invested, how much cash being invested into inventory. So actually, pretty simple is the level of your working capital. So here you can see, if you are holding a very low level of working capital, usually it's actually aggressive, high risk, high return. Because like inventory, cash, all this working capital, you hold a very little. So you're using a very little capital to do your business. It means that usually it indicates you are more efficient if you're able to do so. So your return will be higher. Okay, because you just use a little working capital only. All the surplus one, you use that for investment, for long-term investments already. Like the cash inventory, you hold a very little to run your business. You are more efficient, so return higher. But I think you also understand that the risk is also very high. Because anything happen, you might have the problem of running out of inventory because you're holding too less, or you have a problem of running out of cash, liquidity problem. So high risk, high return. If you are holding a very low level, then it's aggressive. If you are holding very high level working capital, then it's conservative, very safe. A lot of cash, a lot of inventory is very safe. But the return will be lower because you are not efficient, holding too much. Moderate will be not too high, not too little. In between, aggressive and conservative. Can understand? This one is about investing. So remember, if I ask you investing, you don't talk about what short-term finance, long-term finance, that one for financing one. Investing is purely on the level of working capital, that's all. You hold a lot of working capital or very little working capital, that's all. For investing policy. All right? And when we come to financing policy, you will always see this one. Okay? So this is about financing policy. Okay, so let's talk about the assets first. Fixed assets, I think all of you know. Permanent current assets will be the level of current asset you need to maintain forever to do business. So this one, even though there are current assets, but actually the needs will be permanent forever one. Like the example given by me. Like if I know my shop every day at least 100 units, I can sell one. So the 100 units will be my permanent current assets. Inventory level. Because I know if I want to do business, just like usual, I want to do business, at least I need to have 100 units of inventory, at least. So that one is what we call permanent current asset. Just to continue business like usual, you must have this amount of current assets. All right, so it's permanent needs. While fluctuating current assets will be temporarily one. Example given by me also, if I'm a owner of a stationery shop at Thai, you see during exam, physical exam, so maybe the sales will be higher. So I need to keep more inventory during that period. So it's for temporary only, for 1 month only maybe. I need to purchase additional maybe 100 units of pen just for that 1 month. Okay? So working capital, but working capital financing policy has nothing to do with the assets. Is how do you finance all these assets? By using short-term financing or long-term financing. Let's talk about moderate first. And I think short-term financing, I use green color. Long-term, I use red color. Short-term financing will be just like short-term borrowings. You borrow money for 1 month, 2 months, they want short-term. Long-term financings including everything, equity financing long-term, or you issue a 10 years bonds, borrowings, debt financing long-term will be under this one. All right. If we are talking about moderate working capital financing policy, it means short-term needs financed by short-term items, long-term needs financed by long-term items. So it will be like that. You see something like that. Based on what we call matching principle. Okay, what does it mean by matching principle? Very simple. Like just now I said, or due to some seasonal factor, maybe an examination period, so I need to purchase more pens to sell to the students. That one is short-term needs. The examination period is only for that 1 month. So maybe for that 1 month, I need to keep more inventories. So this short-term needs, I need the money to purchase additional inventory. When I go to look for the money, I will use short-term financing. Like for example, I borrow 1 month loan. So I have the money to purchase the additional 100 units of pen. Short-term for short-term. While long-term, like what I said, even though permanent current assets, they are current assets, but the needs will be permanent. So it's still considered long-term needs. So long-term needs financed by long-term financing. So this one is what we call moderate working capital financing policy. It's about how do you finance your assets. So here it's saying that short-term one financed by short-term law, long-term needs financed by long-term law financing, matching principle. Can you understand this one? So now I want to talk about aggressive. Okay, then what does it mean by aggressive? If let's talk about aggressive, which means high risk, high return, aggressive. Aggressive. Yeah. Okay. When we talk about aggressive, will be when we are using the short-term financing as long as exceeds this line. Because, okay, if for example, put it as an example, if you see something like that, it is already aggressive working capital financing policy. Why? Because in here you can see this company is using the short-term financing to finance not only short-term needs, but also part of the long-term needs, So if the company is doing that, advantage will be high return. Okay, why? Because short-term financing is cheaper one. This one is always cheaper than long-term financing. So if you are using more short-term financing, it is cheaper. So you have a higher return. But at the same time, it comes with higher risk also. Because you try to imagine, you use short-term financing to finance long-term item. Short-term financing, it means that very fast you need to repay the loan one. You can finance long-term item, you keep on reborrowing. I mean, matured already, then you reborrow. Matured already, reborrow. You can finance long-term items. But when every time you reborrow, there will be a risk. Can you reborrow? If like financial crisis or anything's happened, the bank does not allow you to reborrow or refinance, then you GG. Because you try to imagine, if you cannot reborrow, refinance, and when this one the other, you can't even maintain your permanent current asset. You do not have the cash to maintain even this level of permanent current assets. So which means that probably you cannot continue to do your business. So it's very risky. But the more short-term financing you are using, the good side will be higher return due to lower cost. All right. As long as over this line, then it's already aggressive. You can even use, if you want super aggressive, you use short-term financing, finance everything, can or cannot? Can, no problem. No any long-term financing, all short-term. You can try, but it will be extremely high risk. You need to keep refinance, reborrow. Okay, so now we talk about the last one is conservative. Conservative as a conservative working capital financing policy will be when here only a little. As long as you are using long-term financing over this line, then we will call that conservative working capital financing policy, which means part of your fluctuating current asset, like actually you need the inventory for 1 month only, but you go to borrow 3 years loan for that 1 month. Can or cannot? Can also. But that one will be very costly, so your return very low. But you are very safe. Your risk is very low. Why? Because when you borrow 3 years, it means that you have 3 years time to repay the loan. So which means if you use the money for 1 month, if the business is not good, 1 month later, you also no need to worry. You still have time to repay the money. You have 3 years time. So it's very safe. But the downside will be very expensive, so that's why the return very low. So that's why conservative will be low risk, low return. Okay, I hope you understand that. So make sure you know the differences between the working capital financing and investing policy. Totally different. Even though both of them, they are also having moderate, aggressive, conservative, but they are totally different things. Investing is about level of working capital, as simple as that. But financing is harder because financing, you still need to look at, how do you finance your working capital using short-term or long-term to decide, is that a moderate, aggressive, or conservative? All right. I think that's all for the revision for today. And we may continue. Question 2, I think one group is going to present question 2.
So I will be presenting question 2.
Okay.
So this is the questions. Then I will present part A. So for part A, we need to use relevant working capital ratios to evaluate whether warning call can be described as overtrading. So for my group, we have about 8 working capital ratios. Okay, then the first one is net profit margin. So we use PBIT divided by revenue times 100% to calculate for both years for comparisons. And current ratio is use current assets divided by current liability. Quick ratio is current assets minus inventory divided by current liabilities. Inventory days is inventory divided by cost of sales multiply 365 days. So we calculate for both years and compare it. Next. Then following by is the receivable days. We use trade receivable divided by revenue multiply 365 days. Payable days is trade payables divided by cost of sales multiply 365 days. Net working capitals, current assets minus current liability. Lastly is the revenue divided net working capital. Revenue divided by net working capital. So for both years, we just compare it, and next is the explanation. So based on the calculation, there is a decrease in net profit margin from 36 to 20. From 36 to 28%. So it shows that increase in revenue from 10.375 million to 14.525 million. This could be because the company wanted to sell at lower margins to improve its sales volume. And followed by is the increase in current assets. It's increased from 2.826 million to 5.349 million. So this rapid increase is mainly contributed by the increase in trade receivables from 85% increase and increase in the inventories by 97%. So followed is the increase in current liabilities, an increase from 1.887 million to 1.887 million to 4.365 million. So it shows that the company financial ratio activities are increased through liabilities, and the overdraft had also increased sixfold, and the payables increased 75%. So the payable days also have increased from 90 days to 100 days, which show that the company is having financial difficulties to pay the trade payables. Next. So followed by is the decrease in current ratios. It's decreased from 1.5 times to 1.2 times. So while the average ratio is 1.7 times, so this shows that the companies had problem with managing its inventories of inefficiency in managing its trade receivables compared to other companies in the relevant industry. So the decrease in quick ratios is from 0.7 times to 0.9 times to 0.7 times. So this could be due to the company is borrowing more, as seen in the sixfold increase in overdraft and poor management in trade receivables. The ratios being lesser than one indicates that the company is having problems meeting its short-term obligations. Then increase in receivable days from 60 days to 80 days. This means that the company is inefficient in collecting receivables, or that the receivables are taking longer than expected to pay the bill. Lastly is the increase in inventory days. So from 60 days to 75 days. Average ratios companies like Warning Call is 55 days. This refers that the company is expecting the sales volume to increase in the future. So in conclusions, Warning Call is overtrading from the evaluations above.
Very good. Okay, everything is correct there. I think you may continue for B. Then later on, I will give you an overview also for this question.
Okay, we are required to discuss both the working capital investment policy and working capital financing policy. Okay, so working capital investment policy dictates how much a company choose to invest in current assets for its investment decision, while working capital financing policy is to determine how a company funds its day-to-day operations with short-term and long-term source for financing decision. So both working capital investment policy and working capital financing policy are described in the term of conservative, moderate, and aggressive. However, these terms mean different things in context of investment and financing. So for the working capital investment policy, a conservative policy is aimed to reduce the risk of system breakdown by holding high levels of working capital, which include general credit terms for customers, high level of inventory, and quick payment of suppliers. This might show a huge figure for the current asset. And for an example, right, like the company providing a generous credit term to the customer, right? which means that usually if let's say the sales credit term is 30 days, but then the company give a generous credit term, like I extend it more. I give a 90 days credit term, which means the supply, the receivable just need to pay within the 90 days compared to others company that offer 30 days only. Then it might affect my collection actually, because my collection is very slow. If like that, I can only receive the money within 3 months compared to others company. I can get back the money in 1 month. And then for the high level of inventory, I invest more in inventories, right? Which means I need more money to buy the inventory, to purchase for the inventories. Then the money might come from the financing. So I might have a high finance cost for this case. And for the quick payment of suppliers, refer to the credit term, right? I receive the money very slow, but then I make a quick payment to my suppliers. Then I might face the financing cost. So this approach can result in a high financing cost and may give rise to cash flow problems. That's what I explained just now for the examples. And then for the aggressive approach is to reduce financing costs and increase profitability by cutting inventories, collecting debts early from customers, and delaying payments to suppliers. This means that this might show a low amount of the current assets. So it is opposite from the conservative policy actually. So I might invest just a minimum level for the inventories. So I no need to borrow much money from the financial institution. So I might have a low finance cost for this case, and then I didn't offer a generous credit term, which means I can get back the money very fast. So I have more opportunities to invest in others things that I can get more returns. So next, the delaying payment, maybe I just maybe I get the credit terms from the supplier 30 days, right? I just pay 30 days I'm not giving a quick payment so I can make rolling the cash for others opportunities. So next, please. Okay, for the working capital financing policy, right? The current assets are divided into permanent current assets and fluctuating assets. So the permanent current assets are the level of current assets that supports a standard level of business activity, and fluctuating assets are the level of current assets that rise and fall due to unexpected business demands. Okay, a conservative policy is one that uses long-term funding to finance most of the assets of the company, calling upon short-term financing only when fluctuating in current assets push total assets above a certain level. This one is opposite, right?
Conservative approach is one that uses long-term funding to finance most of the assets. Correct. Calling upon short-term financing only used for only when fluctuating in current asset push total asset above a certain level. Correct.
Okay. No, I confused already. Okay, so I make long-term financing, right? So I might have a high finance cost So it might lower down my returns actually. And then other else besides that, I could say that actually it underutilized the sources. So underutilize the sources, so it might cutting down the returns and compromising the growth. For the aggressive policies, right? Is one of that finance all fluctuating current assets and some permanent current assets out of the short-term resources. So I just get a short-term finance, right? Which means I need to repay the short-term finance and then keep borrowing for the short-term finance. So if let's say the short-term finance, right, suddenly I didn't get the short-term finance, I might face a cash flow risk, crisis lah, because of I cannot grow the operation anymore. So therefore, the working capital investment policy and working capital finance policy are two different aspects of working capital management policies. Okay, that's all.
Wow, very good, Wei Rong. Okay. I mean, from all your explanations, you explain so much. I understand all of them, and all of them are correct from your explanation, the way you explain. Okay. Actually, I found that, I don't know, I found that your explanation is a little bit similar to mine. The way of, like, explain. Very, very good on that. Okay. I appreciate your explanation. So again, because actually calculations, you all have done well, but that one is picking the figures, ma. I think from what Wei Rong explained, he understands very, very well on, like, the reasons on why aggressive will be high risk, high return, why the conservative will be low risk, low returns. Okay. So again, if you have any questions on this working capital policy, feel free to ask Wei Rong. I guarantee he will be able to answer you. From what he explained just now, a lot, but I can tell you, I listened. All of them are correct. Okay, his explanation and then the examples given, all of those are accurate. Okay, accurate, precise, and also correct. Okay, very good on that. Okay, thank you, appreciate that. So I will present something. I think the working capital financing policy and the working capital investing policy, I'm not going to repeat. I have already given you a revision just now to differentiate, and then plus the Wei Rong also explained very well, okay, on all the details also. I think even better than me. So in the future, any question on this, you ask Wei Rong lah, okay. Actually, I'm very impressed the way that you explain, because it's not easy. Definitely that one is coming out from your mind, you keep on explaining, but everything is correct. I am quite surprised on that at your age. Very good on that, really. Okay, so I don't want to talk about the working, the B. The B is differentiate the working capital financing and investing policies. I have already covered that just now, so I'm not going to talk about that. I just want to add a little bit thing on the over trading. Of course, just now Zihong answered everything correct also. It's just that because sometimes it's very hard for you to see the overall picture on what this question is about. So basically, actually, the question is asking you to calculate some ratios, working capital ratios, and then you need to decide whether this company is overtraded. So first of all of you must understand, overtrading is not something good. Overtrading means that your working capital not enough to support, okay, your sales. It means that maybe your business growing too fast, sales growing too fast, but your working capital, the cash that you are having, the inventories are not enough to support that. So if you lead to a very high cost and the profitability usually drop, so it's not something good. So even though your sales increasing, but if you do not have the enough capital to support your sales, it will lead to a lot of negative consequences. Okay. Oh, how come? What? I have already tried my best for this graph. All right. So from the just now, if you look through the questions when you're doing your revisions, okay, there are a lot of ratios. Again, the ratios, I think Zihong explained that very well already. I don't need to go through one by one, because actually the ratio is something like ratio analysis. We have learned that before. And with the formal answer uploaded later, I think all of you can calculate the ratio. Like the current ratio, all of this, I don't think I need to go through one by one. That one you should know how to calculate. What I want you all to know is the overall picture. So usually, when you have over trading, one of the symptoms, like just now, Zhong also explained, I think in the first ratio there, it's not a first ratio, first explanation, is the sales definitely increase very fast. This one is for sure. Okay, you have a sharp increase or dramatic increase in your sales. Over trade, you are trading too much, the sales too good. All right, and here saying what? If your sales is increasing, it doesn't mean that you are over trade. Don't get it wrong. So because I scared that you're thinking that when the sales increase too fast, then it's over trading. No, If your sales increase very fast, but your working capital can support that one, we call it good business. Okay, thumb ups for that. Very good business, very good, nothing wrong. Okay, over trading is when sales increase very fast, but your working capital unable to catch up. So usually what you will see, like from this question, your working capital will be still increasing one, for sure. Impossible your sales increasing, but your working capital dropping, that one is like impossible, super big problem already. So usually if you look at the question, like just now the question, working capital still increasing, but maybe the increase is like that. This one is your working capital. So if you look at the question just now, the inventory, receivables, they are still increasing one. So nothing wrong on that one. You don't think that, is it over trading? Over trading is saying that working capital not enough, but the working capital of the company increasing, it means that it's not over trading. It's not like that. You need to compare in order to give a conclusion on whether this company is over trading. So usually you will see something like that. Sales increase, working capital also increase, but the gap is getting bigger and bigger, as you can see, which means that it's kind of like telling you not enough to support already your sales really too fast. The working capital, the cash you are having, the inventory you are having, not enough to support the sales already. When this happens, so definitely borrowings will be coming in. Makes sense, like that? When your working capital not enough, but you still need to support, then what can you do? You go to borrow more and more money to close the gap. Okay? And when all this happen, definitely if your company is over trade, definitely I can tell you, you will see this thing, very obvious one. Profitability for sure will drop. Because like what I said, if your sales increase, working capital able to support that, your profitability should increase one. Or if not increase, the profit margin should be at least maintained. You earn the same amount of profit margin. But usually if you are over trade, profit margin for sure drop. Which this one is a very clear indications telling you that something is wrong. Your sales increasing, but your profitability drop. Okay, why drop? Later I will explain. Then you'll be able to link back. So you will see something like that first, all from the questions one, this one. It's not coming out from my own theory. It's all from the question I'm telling you. This is what the question giving you, okay, is happening in the company. And then you will see your inventory turnover period increase. Receivable turnover period increase. Payable turnover period increase. And usually working capital cycle also increase. That's what also happened in the question just now. Okay, so we talk about first one. Why your inventory turnover period will increase when you have a very high demand or very good sales? Because, logically, you may be thinking that if the sales very good, my inventory, I should be able to sell very fast. Then this one should drop one. Yes, that one is assuming good business. You have enough working capital, enough inventory, very good sales, very good, then you can sell very fast. Your inventory turnover period is even faster. It should drop. But why this one increase? Another indication. Why increase? Very simple. Because if you are a manufacturer, why this one will increase? Take longer time to turn over the inventory. It's not because no people buy. Now your sales is very good. It's because you have not enough cash or not enough raw material to manufacture into finished goods and sell. So that's why it's kind of like people order from you. You receive the orders already. But it takes you very long time because too much already. Now you are running out of cash. Like you want to produce, I do not have cash to purchase the raw material. Or in terms of like staff strengths, not enough staff already. The machine also not enough. So it's like keep on dragging. The sales has already been confirmed. You have received the order, but you are telling your customer, wait, we are still manufacturing now, okay, because too good business already. So sorry, so need to wait. So by doing in this situation, maybe you also will incur a lot of costs. Like you need to hire a lot of part-timers with a very expensive price, all these things. It's one of the reasons lead to lower profitability also. Another reason is borrowings. Because like what I said, if you want to close the gates, you need to borrow money. So when you borrow money urgently, then usually they will charge you a higher rate. So that's why it will bring down profitability also. Your receivable turnover period also will increase usually. Because usually the sales, why will you have such a good sales? Usually will be through more generous credit terms given. So this one also increased. And like what Zihong explained just now very well, payables turnover period also increased. Because it's either you need to ask more credit terms from your suppliers. You are running out of cash right now, not enough working capital. So you try to ask more generous credit terms from your supplier. Or why increase is because you do not have enough cash to pay your supplier already. So you keep on dragging. So this one also increase. At the end, overall the WCC also will increase. I mean the cash conversion, it takes longer time. You are having liquidity problems here right now. Okay, so even though you see the working capital maybe increasing, but if you look at the questions, the liquidity ratio, like the current ratio, all this ratio, current ratio will drop. Okay, maybe you'll be asking, why current ratio drop one? Because current assets should be increasing, yes, increasing. But at the same time, in these type of situations, very soon your current liabilities also will be getting more and more to finance the current asset. So maybe you see a drop in the current ratio, indicates that you are having liquidity problem. So all of these things will happen. So from the question, that's what happened. I just show you, okay, in a graphical presentation. So from here, we can conclude this company is overtrade. From all these symptoms, we can conclude it's overtrading. Actually, very simple one. Usually, you just look at, if you want to be fast one, you just look at the sales increase a lot, and then you look at the profitability. If the sales increase a lot, profitability drop, something is wrong already. Because supposedly, if your sales increase, your profit also will be higher. But why this one drop one? Your working capital not enough to support. So that's why you need to borrow more money to finance already. When you borrow more money, more costs being incurred. And a lot of problem from operational side, we have a lot of problems when you have not enough working capital. Like including, because when your sales too good, you fully utilize your staff. So maybe they are too tired, and then, low productivity will happen. All these things will happen. So increase the inventory turnover period and again, bring down the profitability. All of these, they are interrelated, if you understand. Okay, so that's all for question 2, I would say. This one is a general picture of overtrading. All right. So I think we have a break of 2 minutes, then we continue the last question. Last question, very fast one. I think 10 to 15 minutes, we can finish that. It's a very simple question. This one I will explain for you. Okay, I think we will continue for this one. Yeah, it's just a very simple question. So I don't think you need to present this question. I will just quickly go through with all of you. So this question is a question of working capital cycle. So question 3A asking us to calculate the working capital cycle. I don't think I need to show you in details. Later you get this answer. Very simple. Okay. I don't think I need to go through that. You can calculate yourself for the 3A, just calculating the working capital cycle. You just need to know this one basically is the period between you pay cash and receive cash when you are doing a transaction. Calculation, I think no problem. And then the question actually asking you, okay, after you calculate, please discuss whether a working capital cycle should be positive or negative. So basically asking you if you have the choice, you have the call, then you want your working capital cycle to be positive or negative. So usually, for the former answer, usually we will say that the shorter the working capital, the better. Working capital cycle. The shorter the working capital cycle, the better. Because like what I said, working capital cycle is between you pay cash to purchase inventory until you receive cash from your customer. In average, it takes how long? So definitely the shorter the better, because the shorter it means that very fast I can earn one round money. I buy the inventory, I sell, and then I get the money from customer. The shorter the period, the better. If you can make it negative, it's even better. It is possible to have a negative working capital cycle. Like the example given by me, for an example, I think 7-Eleven, some of the items or the products will have negative working capital cycle. Because I believe for 7-Eleven, definitely when they purchase, maybe some of them will be like credit purchase, some of their products. Credit purchase 2 months, let's say, only pay back. Once they get that, maybe that inventory turnover period is very fast. Within 1 week, already sold for the product, and they receive cash. This one is the best. Which means if you have a negative working capital cycle, it's something like you don't need to use your own money, own cash to do this business. Why? Because very simple. Credit purchase, no need to pay first. I sell first. I sell faster than the deadline that I need to pay. And I sell on cash. Receive the cash immediately, and then use the balance to pay for your supplier. Then you can earn money. No need to use your own capital. That's why you will have negative working capital cycle. Of course, it's a very good business model. I also want that. But the former answer also saying, we all understand the shorter the better, negative is even better. But a lot of times, a company does not have a choice on that. So it's not saying that you want negative, that you can have a negative working capital cycle. Because it depends on the nature of business. Just like if your competitors all are giving credit terms 3 months one, you don't follow, you want to sell on cash. And you come, I want to sell on cash. But your inventory turnover period maybe will be half year or 1 year, no people buy from you. So you cannot achieve that also. So it depends on the nature of business also. Okay? All right, and then will be B. Calculate the target quick ratio and the target ratio of sales to net working capital of CSZ Corporation, okay, based on all the targeted working capital ratios given at the end of March 20X5. Okay, in here we need to understand when you are doing your revisions, all the figures given here, they are for 20X4. Right, they are for 20X4. For 20X5, the only information we are having will be here. Okay, we only know that the sales is 40 million. And the cost of sales fall to 60% of the sales. So it means that the cost of sales will be 24 million. That's what we know. The figures for 20X5, we do not know the inventory, trade receivables, we do not have such information directly from this question. We only know sales for next year, 20X5, 40 million. And then cost of sales, 24 million. That's all we know. Then we also know for next year, our targeted working capital ratios will be as follows. All right. And now we need to calculate target quick ratio and the target ratio of sales to net working capital. As you can see, if you want to calculate quick ratio, what do you need? The formula is total current asset. Okay, total current asset minus total inventory minus inventory divided by total current liability. This is the formula for quick ratio. But now the problem, as what you can see, what is the total current asset for 20x5? Data. What is the inventory for 20x5? Data. Total current liability, data also. So how do we get all this information? No worry. Actually, we will be able to get that one. What I said, now what we want is looking for inventory, receivables, payables, all the current assets and current liabilities. We need that for the calculation of quick ratio. So no worry, because you see, inventory days formula, we can reverse that, because I know for next year, our target inventory days 60 days. So I put 60 days here, right? And then this one is the formula. Even though I do not have the inventory level, but I have the cost of sales from the question just now, 24 million. So from here, we can reverse and get back the inventory. All right, I explain right now. So if you understand, when you come to revision, it will be easier. Because this question is just some figures you cannot get directly from the question. So you need to do some reverse in the formula, because you have the targeted inventory days, receivable days, you have all the information. So from here, you can reverse and get back the current asset and current liability. So receivable days, same thing. You have 75 days, you have the sales, so you can get the receivables back. And payables days, same thing. You have the cost of sales, you have the days, so you can get the payables. Once you get the 3, then you can calculate the quick ratio already. Current assets less inventories, okay, will be 8219, and then divided by all the current liabilities. Or actually one more. Because the question, actually we have overdraft, but we do not know what is the overdraft. But after we get these 3, and we know that the current ratio given by the question is 1.4, right, from here. So which means we can put 1.4 equals to total current assets. We have the 2 items here, divided by total current liability. We have payables, but we do not have the overdraft. But never mind, because now the overdraft is the only unknown. So from this formula, we rearrange the formula, we will be able to get the overdraft amount is 5073. Then by doing that, we will be able to identify all the current assets and current liabilities. Then we can calculate quick ratio, very simple. And then also the sales to net working capital ratio also can be calculated. Because the net working capital just using the total asset minus total liability. And then we have the sales divided 11.5 times. Actually, it's very simple, just you need to reverse only. 1 minute for that. Not something very complicated. I believe that when you have the answer, you will be able to understand that very well. And your midterm is until this chapter, working capital. Oh, sorry, the tutorial is until next tutorial, not this tutorial, next tutorial. For chapter 8, for the whole working capital. Oh, I think I give you a discount. I give you a discount. Chapter 1 to chapter 7. Okay, until this tutorial. I give you a discount. See, I am so nice, okay? Considering that your week 7, your week 10, you have another midterm test. All right, so I discount 1 chapter for you. I will post on the Google Classroom, don't worry on that. All right. So give you one chapter discount lah, chapter 1 to 7 lah. For tutorial will be until this tutorial lah. So next week that one also working capital next week, but that one will not be tested in the midterm. I double confirm first. Later I check the midterm test question. Okay, can I understand this one? So the last question. So the last question actually also very simple, just asking us to compare the current assets and current liability positions from 20x4 to 20x5. So this one is just copy paste. If you refer to the former answer, this one just copy paste from the questions only, 20x4. While for 20x5 one, we have already calculated just now in B. We have all the like 39458219 are all here, 39458219 total assets, current assets, and total current liabilities also calculated. So we just copy paste also here. All right, and then the question, after calculated and discuss the working capital financing policy of this company would have changed. Again, working capital financing policy, please. So for the financing policy is about how do you finance your assets by using short-term or long-term financing. Actually, we do not have a lot of information here. We also do not know the current assets, how many percent they are permanent, how many percent they are fluctuating. So actually in here, we cannot conclude this one is an aggressive or conservative or moderate. We cannot do that in this question because we do not know. In here, the like 12164, how many percent permanent, how many percent are fluctuating, we do not know, not given by the question. But at least, if you look at here, we can see that the current assets, can you see any improvement? No, I would say that about the same from about 12 million to also 12 million. So this one, not much changes. But when it comes to current liabilities, and current liabilities will be the short-term financing, we notice that the short-term financings actually increase quite a lot. And you see that? Which means current assets remain, but your short-term financing increased. The company is using more short-term financings. So at least from here, we will be able to tell that the increasing reliance on short-term financing implies an aggressive change in working capital financing policy of this company. All right. But again, this one is not saying that the company is using aggressive working capital financing policy. Like what I said, we cannot identify from this question. But we can only know that the company using more current liabilities right now. So when the company using more current liabilities or short-term financing, then we can say they are more aggressive. But is it using aggressive? We do not know. Okay, we can only say, yeah, they are more aggressive right now using the working capital financing policy. Like a little bit confusing, which means the case of this company is we do not know. We know the total current assets, we know, okay, from just now the question we know, but we do not know the percentage, like how many percent they are fluctuating, how many percent they are permanent current asset. We do not know, right? But what we know will be, when you're talking about short-term financing, the company increased from maybe the case is like that. Increase from here to here. That's what I know, because current asset remain the same, but the short-term financing increase. it could be this case or it could be this case. Increase the short-term financing. It could be this case or it could be this case. Because we do not know the percentage of fluctuating and permanent asset, how many percents for them. So we only know that current financing increase. So the increase, it could be still all under fluctuating current asset, you know. It means that it could be still, it is a conservative policy. Or it could be like that. If like that, it would be aggressive already. But we do not know, okay? Since we do not know the percentage, so what we can say is only saying that since they are using more short-term financing, we say that they are more aggressive. That's what we can say. You understand? A little bit confusing here. I hope you can get what I'm trying to say. All right. So I think that's all for today. Any question you are having? Okay. Discount, okay. Yeah, discount one chapter for you. I double check first. Later I look at, I make sure that really the other first. Should be the other for the inventory management, and then because next week will be inventory management, receivable management, cash management. That one I think the other. Okay, if you do not have any questions, I think that's all for today. I will see you all next week. No question, No question, then bye-bye. Okay, I think that's all. Bye-bye.